Our next guest is tracking a few macro headwinds and tailwinds we could see under the second Trump administration. For more on this, we've got Jason Bronchetti. He was the Chief Investment Officer at Lincoln Financial Group. Jason, good to have you here with us. So first and foremost, as we think about those potential headwinds and tailwinds, what potentially are you tracking here at Lincoln Financial Group, and what could potentially play out?
Yeah, well, first of all, Brad, thanks for having me. It's great to be here with you. And there's a lot going on. The one question that we've been getting the most from clients has really been around the new administration and what that might mean to some of the specific headwinds and tailwinds. And it makes sense. We're at a point of certainly considerable volatility as well as noise around what might be shaping the economy from a policy perspective. So if I take a step back and think about that, some of the tailwinds we see certainly from a new administration have been really focused around the tax reform, reduction in taxes, both at the consumer and the corporate level, which have the impact of improving profit margin and improving income for individuals. In addition to that, deregulation, something that's clearly front and center, and I think something that can be accounted for reasonably easily and can be implemented more quickly than perhaps some of the things that take congressional input and influence. So some positives out there, certainly driving things along with just animal spirits. On the negative side, though, longer term with the new administration, there are some headwinds that we see out there, most notably tariffs, trade. We know some of that's out there. I do think that some of the political hyperbole is now going to meet some congressional reality and some of the other kind of the realities of the political system. But nonetheless, that tariff policy is potentially a headwind, as well as deficits, which we know have caused rates to rise, albeit calming down a bit here more recently. But so those are some of the key headwinds, tailwinds. But the big thing for us, we're taking a step back and trying to make sense out of all the noise out there, helping investors settle in. We serve about 60,000 financial professionals and 17 million customers. And what we try to do is distill down that noise, bring it to those financial professionals, investors to make sense and cut through the noise.
With those headwinds and tailwinds that you mentioned, what kind of sector dispersion are you anticipating?
Yeah, we're definitely seeing an opportunity for some other sectors to perform well that haven't most recently. And I think you look at that from an administrative perspective. I think the financial sector as well as the energy sector have the potential to perform well. They've certainly not performed as well of late. We still like, technology still makes sense. I think that the Mag 7, as much as they've run, they are companies that have real economic moats and real value to be added. So, we're talking a lot with folks about just taking the time to check in, think about rebalancing your portfolio. It's a good time to do that, given the run-up that we've seen in the markets over the past couple of years. I mean, 20% years back-to-back, led by that Mag 7, may be causing for some impacts in the portfolio that may be unintended. So just making sure that folks are taking the time to rebalance and think about their allocations, as well as just diversification, thinking about ways to diversify the portfolio, not just from a sector perspective, but from a more of an asset class perspective, value, international, et cetera, and also bonds. We've seen that bond funds have really suffered given the rise that we've seen in interest rates over the past couple of years from a total return perspective, but it's really a great time to be adding income to the portfolio. So it's another thing that we like. And then third, I'll say is private markets. We're definitely seeing an opportunity for private markets. We invest in them considerably within our own general account on the institutional side, and we're seeing more and more opportunities for individual investors to take advantage of private market strategies that have historically only been available to more institutional or high net worth individuals.
So that kind of spells out a portfolio checkup for investors and looking for areas to rebalance.
Absolutely.
What would you say is a good rule of thumb as part of that rebalance?
Well, I think that the rule of thumb is always to think about your financial objectives, your liabilities. We think about asset liability management very much as an insurance company. We want to think about what it is that we're trying to achieve, what those objectives are, and then design a portfolio that over time will meet those objectives regardless of the economic backdrop. So try not to think specifically about the particular point in time of the economic backdrop, thinking through the cycle, thinking about the duration of your liabilities or when you'll need income, retirement, et cetera, and really making your planning thinking from a portfolio perspective, from that long-term perspective, such that you can achieve those goals regardless of the noise that's out there in the market around us.
You call the last few years a roaring 20s for the markets. What are the chances that this trend will continue? What do we need to see in the back half of this year that sets up perhaps the second part of the 2020s?
Yeah, absolutely. So, we've seen 2 consecutive years of more than 20% growth in the S&P 500. And this in and of itself is not necessarily a reason to be bearish. We've done some good research on this. Going back since 1950, there have been 8 other instances in which we have seen 2 consecutive 20% plus back-to-back years in the S&P 500. And of those 8 instances, 6 of those times saw markets higher a year later. So 75% of the time, the market's gone higher later, and gone higher by a considerable amount. 12% is the average return. Now, typically it does come with some degree of downturn in the process, and I would say statistically, I wouldn't be surprised to see some type of a downturn in the markets here, given the volatility that we have seen. Average market will have a downturn of roughly 14%, and then go on to produce new highs. So I wouldn't be surprised to see that happen. But I think big picture, if we take a step back and think about the economic fundamentals, the economic fundamentals are key, and they still look pretty good. You've got growth is easing, but still growing. We saw the leading economic indicators were in line today. A little bit softer, showing a declining trend. The labor force has softened, but is in pretty good balance. And inflation, the Fed has done a pretty good job with inflation. So against that backdrop, things look pretty good. I mean, we say that there's an old adage that bull markets don't die of old age; they're murdered by the Fed. And I think the reality is that the backdrop sets up pretty well for the Fed right now. While that easing may subside, because the economic growth is pretty good. So be mindful of what could be out there. We could certainly see some exogenous shocks that could change things. But where we sit right now, and where we are in this particular bull market, that's about 27 months in relative to a typical bull market on average, which runs over 5 years. The backdrop looks pretty balanced with certainly opportunities for growth and a bit of volatility along the way.
Lincoln Financial Group Chief Investment Officer Jason Bronchetti, thanks so much for taking the time.
Thank you.